Hello, this is Nolan Sampson, the Director of Business Development for the Halderman Companies. And today we are excited to have our quarterly webinar with Todd Kuthi and Howard Halderman. I will be moderating things, so if you have any questions as we get rolling here, I'll take questions in the chat and I'll send a chat to everybody so that you can reply directly to me. And to get started, we'll start with Todd. Todd is an associate professor and Schrader Chair in Farmland Economics in the Department of Agricultural Economics at Purdue. Todd has an active research and extension program in farm real estate markets, agricultural finance, and agricultural policy. With that, Todd, I think we'll get started.
Perfect. Thank you for having me. Let me see if I can get my screen share to work. All right. So like most professors, I have probably way too much material to try to cover in any set time you give me, no matter how much you give me. So I might go a little quick at times, but I see we're being recorded so you can study up. Or if you have any questions, always feel free to reach out to me. Like Nolan mentioned, I have an extension appointment. So part of my regular responsibilities is interacting with stakeholders and folks around the state, whether it be landowners or appraisers or farmers looking at sort of land market issues. I'm going to give just sort of a brief overview of kind of where the land market sits according to kind of what I follow and how I think about markets, and a little bit about sort of where I think it's going to go in sort of the near term, not a lot of like very long run projections. So kind of jump in. I imagine most of you are already familiar with the idea that land is incredibly important to the financial health of the ag sector. So it's often called sort of the farmland prices are the barometer of the financial health of the ag sector. Let me see if I can move this. No, that's not how I do that. Okay, hang on a second. I always have to shuffle things around. So this is the balance sheet of the Indiana ag sector. This is produced by the USDA Economic Research Service. It's nice for us here in Indiana that we get this detailed information. They only cover about 15 states, but the downside is it moves a little bit slower. It's quite a big data process collection. So 2019 is as current as we can go. But you can see we have about $1 billion of farmland here in the state of Indiana. It's about historically usually between 75 to 80% of the value of all of the assets in the ag sector are used in farmland. So it's the major wealth holding of the farm sector. It's everyone's retirement plan. It's everyone's sort of inheritance. It's also used as collateral for lending. It's a big sort of the backbone of the financial health of the ag sector. I mentioned previously also when it comes to debt, so mortgages only account for about half of the value of all of the debt held by the ag sector. And as a result, that's why we have such a low debt to asset ratio. I know that our debt to asset ratio has been increasing sort of the last 10 years or so, but it's still very low compared to other sectors of the economy. Even if you look at just small businesses, usually that sector of the economy will run with about 50 to 60% debt. And then publicly traded businesses are closer to 2/3. So we have a very low sort of debt to asset ratio. So it helps keep the solvency of the sector. The big news of the last year, which I'm sure all of you have seen, is that land values are at a new record high. So this comes from the USDA. The USDA National Ag Statistics Service has been collecting farmland prices since consistently since the early 1900s. And we're at a new record high in terms of nominal values. This is a survey they conduct every summer. It's released sort of in August or September, but it's based on a survey in June where they survey farmers all around the country about their land values as part of the planting reports. And we can see we're at a new record high, but this is pretty consistent, sort of a different place. So I'll show you some other places where I look at sort of farmland prices. This is actually the farm real estate. And I should also point out, they define farm real estate as the value of both land, buildings, and improvements. But here's where we are sort of sit around the Corn Belt. You can see we're much higher than the rest of the country. This deviation really started about in the 1960s or 70s and has continued today. Iowa and Indiana tend to sort of duke it out for the top two positions. Iowa and Illinois duke it out for the top, and Indiana's kind of rides right there in the middle. But all of them are showing pretty high appreciation over the last year. I also track the Federal Reserve banks around the area, do a lot of surveys as well. They survey quarterly ag lenders, and they ask about land values. Now, one of these a little bit difficult is they don't report dollars per acre because they don't want to be sort of ever quoted in sales, given their regulatory portion of their activities. And so they just report percentage changes. So I've converted these into an index going back to 2012, beginning 2012. So you can see how the price index has increased. And we've seen a real rapid uptick starting around 2020. So I'm showing here two Federal Reserve districts, St. Louis and Chicago, Chicago serves about the northern 2/3 of Indiana, and St. Louis, the sort of bottom third of Indiana. But keep in mind that these values also cluster in those other states. And so the St. Louis maybe isn't representative of Indiana, given the high proportion of Delta states that'll be represented in there as well. But either way, they're both showing this rapid uptick that we saw around 2020. And then most recently, Iowa State, my colleague Wendong Zhang runs a survey there that they've been producing since the 1970s as well. And they posted a new record high in their survey that came out in November. It's somewhere around 30% increase over the last year, just an absolute takeoff in Iowa. You can see similar to what we had here in Indiana, that they peaked around 2014 and then sort of had a slow gradual decline, been plateauing for several years. And in the last 2 years had a really steep appreciation. And then finally, the survey we run here at Purdue. So I took over the survey from Craig Dobbins a little over a year ago. But we've been running this survey at Purdue since the mid 1970s. Some of the advantages over our data over the USDA is that we collect information about land quality. So we ask all of our respondents, which includes appraisers and brokers and some professional farm managers. We also have lenders in there. We ask about top, average, and poor quality land in their county. And for each of that land class, we ask them to give us an estimate of the long run corn yield. So we can sort of put this on a kind of per acre, per yield, bushel yield expression. But this is sort of the state level across Indiana. And you can see we're again at a new record high. We're up just slightly above our previous peak in 2024 after a few periods there of kind of bouncing around or sort of a stable plateau. So we've increased, since I took over the survey the last 2 years, prices are going up. So I like to say that that I'm improving the land prices. But one of the things to kind of keep in mind is that these are the prices I showed before were nominal. And so what that means is that's the price that we see in the marketplace. But as you may remember from your Econ 101 classes, we're also concerned about inflation, right? So the purchasing power of our dollar. So if we look at sort of the real value, which is what is the price when controlling for inflation, we're still below where we were in 2014. That's that dashed line here. So although we're seeing an uptick in both real and nominal, we haven't in real terms surpassed our previous peak. So why is it that land prices are up? So we ask our respondents to the Purdue survey to rate a number of things. I show you here 10 factors, and we ask them, is this a positive influence on price or a negative influence on price? And they give us a number value between 5 and -5. And the black bars here represent the most recent survey of 2021. So we did this last summer. And for the first time in several years, all of the things that can put pressure on farmland prices are putting positive pressure. So we had very good commodity prices, or at least commodity prices well above what were expected. High net incomes, high growth in returns. We have a lot of uncertainty, so the alternative investments makes farmland seem more attractive. Our exports are ticking back up, and interest rates have remained low. Ag policy has been accommodating, so we've had policy support through the trade aid payments that were during the Chinese trade war, but also all kinds of payments related to COVID and COVID support. So basically everything that could put positive pressure on land values has. And as a result, that's allowed us to have a higher rate of appreciation. So kind of going forward, how do we think about what's going to happen over the next year or two? And really, I used to put an equation at this point in the graph, but I found that over Zoom, people are even less tolerant of wanting to see any math. But if you remember back from your kind of Econ 101 or Finance 101 classes, the way we think about the value of an asset is we look at the money that we could get by earning it, the income, and then we discount that, meaning that we favor payments now to payments out in the future, right? So we have things like inflation. There's a lot of uncertainty. We don't know if the future will happen for us. We're impatient consumers. We can always invest it in something else. So we always favor money now to money in the future. So we look at what income can we generate from owning farmland? That's the first part. And then we have to think about how we discount those incomes in the future to arrive at what we think the current value should be. So that's a relatively simple model. So the first thing I always look at is income. This again comes from the USDA. This is the Economic Research Service. They produce an estimate of farm income for the entire United States. So this is the farm income sector. So this is a lot like when we think of things like unemployment or GDP. These are big national measures. They're not necessarily representative of any individual firm, and they have the conflicts between, grain producers and livestock producers and dairy. You have different parts of the economy that are doing poor and some that are doing really well, but sort of offset what is sort of the general sector of the economy. So they produce the estimates of farm income every year, but they don't release them until the next August. So it takes a long time to be able to measure the income component. So they release a series of forecasts. So that's what all these sort of dots of various colors and shapes are. These are the forecasts that we see throughout the year. So a couple numbers I want to bring attention to. First, this is from last year, 2020. The official estimate was $94.6 billion. They're forecasting an increase this year, the most recent forecast of over $116 billion. So they're expecting farm incomes to increase. And this will follow a couple of years of recent increases. Farm incomes have been increasing since 2016. But if you look at the recent trajectory, the last few years, they've actually been over predicting income at this point. So I think we'll still see income growth, but I don't necessarily think it'll be as high as what the USDA is currently forecasting. I think there's going to be some room for that to come down, but I still think overall still positive, but not necessarily, going gangbusters and producing extreme returns over the next couple of years. The other thing I look at when I think about income is cash rental rates. So I always say the easiest way to make money owning farmland is to just rent it out to someone else and let them worry about the farm income component. And you can see we've had increasing cash rents over the last couple of years here in Indiana, but they've increased very slowly, actually much more slowly than we've seen the land value appreciation. And so what that looks like when we think about sort of the cash rent to land value ratio, since the mid 1980s, that ratio, that cap rate has been suppressed. It's been decreasing. We hung around 3% for a long time. And then with the uptick we saw in prices over the last year or two, has pushed it down to about 2.8%. Now, this isn't unusual in the economy. The cap rate for a lot of assets has been decreasing sort of universally over the last several years, up to the last couple decades. But we're sort of seeing this downward pressure between the growth rates between cash rent and land values. The other thing I think about when I think about land, the rents, is we can again use that same net present value idea. So this is the rental, the gold bar here, gold line, represents the cash rental rate for Indiana. This is for average quality land. The cash rental rate divided by the 10-year treasury. So this is kind of a measure of a potential discount rate that we can use to think about how we capitalize that income. If you go all the way back to the late 70s, early 80s, you can see this is where the land values were above what that combination of discount rates and rents suggests they should be, which is what economists use to define a bubble, right? So if the prices go above what the fundamentals suggest, we can get this sort of gap in prices. We call that a bubble. Even with these very high appreciation rates we've had over the last 20 years, particularly the last couple of years, we're still well below what the capitalized rental rate is. And a lot has to do with very low interest rates. But essentially, as an economist, what we'd argue is that farmers aren't fully bidding in to what land values could be. So I often interact with farmers and they say land prices are way too high, they shouldn't be this high. And this is a graph to show, actually they could be higher. We're bidding in some expectation to say land values won't always keep appreciating at this rate. We don't think interest rates are going to stay this low forever. And so low evidence of a bubble. The other way that's really easy to make money with farmland is to convert it to something else, right? So that's where often sort of windfalls occur. I say easy, I mean, it's actually easy, but we tend to see, so with our Purdue survey, we also tracked, we asked about land transitioning out of agriculture. And that's this gold bar here, the gold line. So the below is the top average and poor, which I showed earlier, going back to 1990. And we can see that the land values for transition is always well above even high quality farmland. It's sold just for farming purposes. If we think about that in terms of a premium, a lot of years, it's essentially about double the value of top quality land is enough to entice it out of production. And so that's what I have here. So this gold, dark gold, is what I call the development premium or transition premium. So this is the percentage difference between the land value that's transitioning out of agriculture and top quality land. And you can see that for a long time, it was well over 100%, meaning doubling of land. This black line is construction starts here in Indiana. And this series, unfortunately, goes back to 1990. But you can see we had very high construction values that were increasing till about 2005. And that meant that the premium for development was also increasing. In about 2005, just ahead of the financial crisis, we saw a real reduction in construction starts here in Indiana. And as a result, the transition premium, again, starts to decline, right? So as there's less demand for new construction, then we have less demand for converting farmland. Starting in about 2010, 11, 12, we've been rebuilding that number up again gradually, and you can see that transition premium has been increasing, but we're still well below what we were in the end of the late 90s. So I don't think that we're going to see, at least statewide, a big driver of land being the conversion. Now, obviously, we'll still have pockets where there's a lot of construction, a lot of land conversion. But overall, this doesn't paint a picture to me of like extreme worries about farmland loss. So those are the two sources of income, right? So we have income through farming or income through transitioning land out. So then we have to think about, well, how do we discount those? So I have three different rates I want to show you here. So this gold one at the bottom, the very light gold, is the federal funds rate. So this is the rate set by the Federal Reserve's Federal Open Market Committee. They meet several times a year to figure out what the discount rate should be, which is what rate that the Federal Reserve pays banks on overnight deposits, right? So this is, when you hear about the Fed changing interest rates, this is that rate right here, this light gold rate. And you can see, starting in the financial crisis around 2008, is when they collapsed interest rates down very low, and they kept them very, very low for a long time. And then we started to build them up again. And then we reach the start of the coronavirus pandemic, and they drop them back down again, keep them near zero. The next rate up is the prime rate. So this is what a bank charges on business loans to their best customers, their safest customers. And the spread, or the difference between that prime rate and the Fed funds rate, is essentially their cost of doing business. That usually hangs around 3%. So whatever they can get paid on overnight deposit, they'll charge about a 3% rate to their best customers. This dark gold line is the farm mortgage rate. It's published by the Federal Reserve Bank of Chicago, which I showed you some of their data earlier. And you can see that the farm mortgage rate tends to move along with the federal funds rate and also the prime rate. They have the same general pattern, but there are times where the mortgage rate is below the prime rate and times where it's slightly above the prime rate. And that has to do with the relative risk of the ag sector compared to the broader economy. And you can see since 2018, this number has also been declining. So the reason to show you this is say, well, we have a lot of different ways we can discount. And if we give somebody the same income stream, they can choose different discount rates based on their preferences, right? So I always tell my students that it's a lot like when I was in high school and I'd borrow money from my dad. He didn't have very much faith that I'd pay him back right away. So he had a very high discount rate if I borrowed money from my dad. Now that I have a job, if I borrow money from a bank, they set it, based on the market, right? So we can see very different preferences. And often I'll have farmers come to me and say, there's been some high profile sale in the area, and I just don't understand how they think they're going to make that much difference in the money. And I said, well, they may think they're making the same, but they have different preferences about the discount rate. The other thing is to show you that there's not a lot of link between, or there's a very sort of squishy link between what the federal funds rate does and what we see in ag mortgages. And so there's already talk about, is the Fed going to start raising rates again, worries about inflation, and the idea that we're going to start having increased interest rates, increased expenses in terms of cost of borrowing. How's that going to factor in the ag sector? That's got to put downward pressure on the land values. And this is just to show that even if we have some short run rate increases, you can see that the rate increases we saw last time when there was as rate increases, those at for farm mortgages were much slower, much more muted growth rate than compared to the prime rate for federal funds. How are we doing on time? Okay, I'll touch a couple things real quick. I know I'm throwing a lot at you very quickly. So we do the survey here at Purdue for land values, and we release it every summer. And then I also include a couple of additional articles about sort of farmland markets in general. So if you don't currently get that survey, send me an email. I'd be happy to put you on our list. Also, if you are someone who works in land markets and would like to be a respondent, I also am always looking for people for that as well. But I wanted to highlight a couple things that I did with a grad student about farmland markets here in Indiana for that report last summer. So the first is just, how does farmland compare to other investments? And so this is kind of a smaller snapshot of the broader report. So if you want to see even more in-depth analysis, it's there, but I don't want to bore everybody with too many statistics early. What I'm looking at here is the returns, the average return. So how much can you expect to receive from owning a particular investment? So here I'm showing S&P 500. That's just sort of a measure of stocks or equities markets. The 10-year treasury to represent government bonds. I threw gold in there because people, for some reason, always want to hear about gold. I don't totally get it. And then the last one is the average quality farmland here in Indiana. So this is, I should say, for farmland, this is total return. So this is the appreciation of the base asset value as well as average or rental income. So looking at that total return to farmland. And so we're looking at three different things. We're looking at the average return. So what can we expect to receive from owning it over that investment horizon? I'm looking at the standard deviation. So basically, how much do those returns move around over time? How variable or how risky it is? And then looking at the coefficient of variation, which is just that relationship of mean divided by standard deviation. So that gives us kind of a risk-adjusted measure of return, kind of a level playing field. And I'm looking at several different investment horizons, a very long one of 1980 to 2020 to the shortest of 2010 to 2020. And you can see over those periods, farmland tends to kind of sit in between treasuries or in between treasuries and stocks, right? So you tend to get more return than you would by just holding bonds, but there is a little bit more of a risk. You can get much higher returns by investing just in equities, but it's a very high variance. So if you're someone who's risk averse, you'll tend to prefer these sort of safer assets. And farmland is really nice because it kind of sits in between those two. The other thing about farmland, if we look at the correlation, or what's the relationship between all these investments. So this is the correlation between Indiana farmland and bonds, inflation, housing, gold, S&P 500, and the treasuries. Farmland tends to have very low correlations with other investments. Where they do have higher correlations, like we see with bonds, those are negative correlations, meaning they tend to move in the opposite direction. So as bond yields tend to go up, farmland tends to go down. So it offers what we consider kind of a hedge. We often think about it with terms of CPI here, right? We see sort of zero correlation. And so we see no movement there. So it allows you to have kind of a hedge against any movements in other parts. So it sits really well in a portfolio. And then the last thing I want to show you here is some data I collected on transaction rates. So our survey data, we asked land market experts and professionals about their opinions about farmland markets. And so I was able to acquire some transaction data across the state of Indiana to do some comparison. So a couple things I wanted to show you here. One is that the black bar, the black line, this is the number of transactions across the state of Indiana from 2016 through 2020. These are monthly transactions. And the gold dashed line is the acres transacted. So this is acres that are sold. I tried my best to remove any land that is not specifically farming. And so lands that were partially timber or had wetlands, I removed those from the sales. These are just transacted acres. And you can see that the transactions stay relatively stable, which also is another thing about, people worry about bubbles. Where we tend to see bubble markets, we see a lot of like movements in, movements out, high transaction volumes, low transaction. So the fact that it's relatively steady is an attractive thing for an economist. That means it's an efficiently moving market. But then the other thing I calculated is the turnover rate. So this is, I'm looking at the transaction at the regional level here in Indiana and the state level. So all the way to the right here, this is the state level. So I took the number of acres transacted and divided by the USDA definition of farmland acres in the state. And you can see when we look at now this is just arm's length transactions, right? So these are not between related parties. This is land that any of us could buy or sell. It hangs around 2 to 2.5%. Is sort of our average transaction rate over this period. So farmland markets are very thin, and that's part of the reason we see this very low correlation with other financial assets. We don't see a lot of movements in and out of the sector based on movements in the broader economy. And then the other piece too is we looked at the transaction values. And again, it's a little bit harder because we're dealing with transactions that can take all sorts of stripes and have very differences. But looking at sort of top average and poor quality land from our survey versus the mean transaction of all transacted land in that area, we tend to see that the transaction level kind of falls within our range of what we expect. So it made me feel very good about the survey. So I know I went through very quickly, had a lot of information there, but if you have any follow-ups, I'd be happy to entertain them, or you can always reach out to me at Purdue and be happy to share more with you. So thank you.
Thank you, Todd. That was fantastic. I think that should give the viewers today a lot to think about in terms of how they want to look at farmland if from an investment standpoint, comparing it to other alternatives. I always find that's a kind of an interesting. I was telling one of the guys sitting in the room with me here in Wabash that at the institutional space, they don't consider farmland as a equity. It is really looked at as a fixed income alternative. And so a lot of times you'll find that along with bonds, compared to bonds as opposed to equities. So anyway, thank you very much. I'm Howard Halderman, President and CEO of the Halderman Companies. Thank you all for joining us today, and look forward. I think we're at about 105 participants, and really appreciate your attendance. And obviously, farmland, with what it's gone through the last 6 months, it's been fairly explosive, and that's what we're going to talk about here in a second. But I think because of the dynamics of that marketplace, it is drawing a lot of interest. So with that, I'm going to share my screen. Nolan, you see the screen all right? Great. So these are my set of slides. I'm not going to deal at the high level that Todd was, because he's covered that. So where I'm going to really go today is going to talk more specifics with you about the farmland market and what we're seeing from a whole different standpoint. And certainly, as I already alluded to, farmland values are strengthening. The farm real estate market, and you might think back a couple of slides where Todd was showing the number of transactions. And he said from, I think, 2016 through 2020, pretty consistent number of transactions over that time period. And some of that is due to this point here, that there have been few outside drivers of farmland sales from 2013 through 2021. Now you saw at the end kind of a jump up, a hockey stick move up in number of transactions and volume. And I think a lot of that was due to the fact that there was a little bit of an outside driver. And you may say, well, Howard, what's an outside driver? That would be like a tax law change, maybe a farm bill change, maybe a completely new crop or a development around Indianapolis. Those kind of things would be outside drivers. And the one big outside driver that we've seen in the farmland space goes back to 2012 and also was a dynamic this past fall. And that is the threat of capital gains taxes going up, or in this case, capital gains law is changing completely. And so with that threat, because nothing has happened, right? All the way back to 2012, we have the same capital gains tax rate and the same structure that we've had since then. But both in the fall of 12, when Mr. Obama was going to be reelected, and then this fall, there was a fear that capital gains taxes might change in some fashion, largely higher. And so we had a number of sellers say, hey, we want to sell markets really high. Both in 2012, it was at the all-time high, and in 2021, we're at the all-time high. So I'm going to clip a coupon and I'm going to get it at a lower capital gains tax rate. So that really was an outside driver that kind of cropped up this past fall that we hadn't seen since really fall of 2012. So as I said, the number of sales improved this fall. What really happens in 2022? Because maybe the capital gains thing is on the sidelines a little bit. It'll probably be part of the BBB, the Build Back Better bill, if that ever passes. So I think there's a little more question mark about that today than what we had in the fall. And so will that spur more sales? Probably the thing that would be purely the fact that we're at the all-time high of farmland values. And cropland values, as a result of that consistent number of transactions, cropland values really were stable the last 5 years. Now we're seeing it move up, and that 18% really comes from the Chicago Federal Reserve Bank. I'm going to show you some statistics where I'm going to argue the percentage shift up is higher than that over the last 6 months. Don't want to forget about this segment of the rural landscape. Recreational land, timberland, and rural residential values are all higher. This is due to lower interest rates. It's due in part to COVID. With the coronavirus outbreak, a lot of folks discovered they could work from home. They could do meetings like we're doing this one. And so as a result, maybe they could live wherever they wanted to, and they didn't have to live in the big city where there were more people. And so as a result, we saw some interest in more recreational land and timberland, living in the rural environment. So we have seen that dynamic, those markets move up as well. So I'm going to lead you on a little pattern here, or to a discussion on our specific statistics. So these are our sales. This isn't an opinion survey. This is our sales data going back to 2013. And one of the ways we look at our farmland sales is based upon its dollars of sale value per corn bushel of productivity index. So for the purposes of this discussion, I'm going to use 150 bushels per acre of corn productivity index. And you'd say, well, Howard, what's a productivity index? That is coming from the soils that are on your farm. And every soil in the state of Indiana, Ohio, Michigan, Illinois, Iowa, they're all rated for their ability to produce corn. The ratings can vary by state. In a 140 bushel rated farm in Illinois is more productive than a 140 bushel rated farm in Indiana. So you really don't want to compare state to state so much, but if you stay within a state, in this case, Indiana, it really gives you a way to compare one farm to another farm based upon its soil productivity quality. So for example, if I had a 150 bushel productivity index farm, and I took that times $60, which is shown here in 2013, per corn bushel of productivity index, that equates to a $9,000 per acre value. And that is what we saw back in 2013 for those really better productive soils. So my purpose in showing you this is where the high was previously, in the low $60 range. We have a lot of variability in our sales. You can see that by this chart, some up as high as $90 and some as low as 30-something. So that shows you the degree of variability that we experience. Every farm's unique. Every farm has a different essence to it, whether it be drainage or fertility or reputation or just soil quality. So you see that variation displayed here in the sales data. But as we go to 2014, we saw the market start to erode. Why? Commodity prices eroded. Not a lot of change in the other dynamics out there, but really a commodity price slippage that we saw in 2014. And so we saw the price retreat into the mid-50s. Now, as we transitioned to 2015, we started the year back up above $60, but very quickly eroded all the way down to 50 by the end of the year. And that was indicative of the commodity price really moving down to where we were closer to 350 corn, $9 soybeans, farm incomes were down, and that was really driving that downward trend. And that was a 15 to 20% decline in farmland values. Then, as Todd showed you on that transaction slide, we really stayed very consistent for the next 5 years. If you look here, 2016 is right at $49 on the red line trend line average. 2017 starts at 48, maybe moves to 51 or 2. 2018 flatlined across there at $49. Now, granted, again, sales vary every year, but the trend line is what we're looking at here, and that really shows you that we've been in a consistent sideways pattern. 2019, start the year a little weaker, back at $45, and we end at 52 or 53. Then we hit the coronavirus year. So 2020, and we started in the high 40s and actually saw appreciation throughout 2020. What's interesting to note here, I have a lot of people ask, well, what was the COVID impact on farmland values? And it didn't have an impact in terms of pricing at all, based upon our data. What it did impact was sale volume. And sale volume, we had a number of sales scheduled for that April of 2020. We moved them all to online only auctions, and then the market just stopped. Didn't crater, didn't peak, it just stopped. And so you see the gap at the bottom of this slide where Q2 2020 to Q3 2020 is a very short gap as opposed to the other gaps. And that's just due to the fact that we didn't have much in the way of any sales for about a 3-month time period there. So that was just kind of the COVID impact. But the point would be here that the strengthening of the market started to occur. Derecho wind event caused higher commodity prices starting in August. Obviously, we had very low interest rates, which was spurring the housing market. And you combine those two factors with a low supply of farms for sale, and we started to see the market move into the mid-50s. As we got into 2021, look at this. We start all the way back somewhere around $50, $55. And the chart has changed because we saw such a dynamic move upward. And now we're trading well above 80 here at the end of 2021. And I think on average, somewhere around $79 for the year. That's a pretty dynamic change. I did some calculations while Todd was presenting, and if you take $55 per corn bushel of productivity index times that 150 bushel farm that I described earlier, that's $82.50 an acre, about what the average was on the Purdue survey. The market has jumped. If you use $79 today, that's $11,850 an acre. And you'd say that, well, Howard, there's no way it's going up $1,000 an acre. Yeah, I might suggest that it has. So let's look at that specifically. Here's the annual average to date for 2021 of Halderman sales, $70.92 per corn bushel of productivity index. What's very interesting about this is the first 6 months were right at 55. So if you recall, we hung at that $50 mark for 5 years. We jump in the first 6 months of 21 to the mid-50s. Look at the last 6 months. The average has been $79, almost $80. That is a 46% increase. So is that jump from $82.50 to $11,008 possible? It certainly is based upon our sales. This isn't 5 sales. This is 30 plus auctions in the Indiana, Ohio, and Southern Michigan area over the last 6 months. So I start to think that becomes a pretty representative sample when it's multiple counties, multiple states. So the 2020 average was $51. The 21 average, $70, almost $71 or a 39% change. So as I said, the market's been pretty explosive. Now, this is first 6 months, we had 17% of our sales over $10,000 an acre. And when I knew the market had changed is we had 5 auctions in 7 days in late August. And all 5 sold above $10,000 an acre. And I looked at Pat Karst after the 5th one and I said, we've not seen this before, where we had that many over $10,000 an acre. And you can see 88% of our 35 plus or minus sales were over $10,000 an acre the last 6 months of 2021. Now, how does that compare to prior? 2020 and 2019, You can see that we did have sales over $10,000 an acre, but it was less than 10% in each year. So here's the way that chart looks. If you look from the last 5 years, if you just took 2016 through 2020, it would be a flat line right about $50. And then you see the jump up that we saw starting in the late Q2 of 2021, making this an upward trending chart on the average. And then here's just another way to look at the jump from a bar chart standpoint. So here's a set of sales that will go back to March of 21, and you're going to see sales specific transactions. And I put all of them in here that qualify. You can see anywhere from 4,600 in Stark County, north central Indiana. Woods and average cropland brings 4,600 all the way to 12,200 at the top in Fayette County. So a lot of variability that creates that bouncing around that you saw in those charts. But a lot of very high prices throughout the year. And this is you see that sale in August in Tipton County, 600 acres, brought 14.5. The next night, Noble County, 11.2. A night or two later, 10,007 in White. And then over in Ohio, 10,008. And then we had the one at 4,300 in Cass County, which was really woods and recreational land. And then bang, we're back at 15, 10, 10 in Cass and Grant. So it was everywhere. It was throughout the whole state of Indiana. Here's a flood. So if you have property that might have flood potential, it's in the floodplain, and this is along the White River down in Lawrence County. Yeah, it can still bring a pretty low number at 3,900. So those kind of prices can exist out there. The bottom one on this is actually a sale we did for Purdue University. It was the Scholar Beef Farm, and that brought 6,100 an acre. And you'd say, well, gosh, Howard, that seems really cheap for Tippecanoe County or Warren County. Well, keep in mind, a majority of this was woods or pasture, and that's what it was most suited for. So if you've got those kind of land classifications, they're probably not as valuable as what you're going to see cropland bring today, but still very valuable for what they are. And so we'll quickly go through one other point. Here's a sale. If you look at the bottom, second to the bottom of this chart, two Tippecanoe County sales that we did just east of Lafayette. For those of you that have driven old 25 between Delphi and Lafayette for years, not the new road, but the old road down along the Wabash River, let's just put it this way. The day we sold these two farms, they were covered with water, flooded. So it floods on every annual year basis, multiple times a year. So if you want to know what Wabash River floodplain's worth, there you go. So as we move into November, some more sales, 11, 12, 15,000 again in Tipton County, 16,000 in Hamilton County. And we come into late November, and this was one that really surprised us. We had 130 acres. Now this is Hamilton County. Hamilton County, Indiana is the fastest growing population county in the state of Indiana. It has been for 30 years, all of my career. It's Carmel, Fishers, Noblesville, those communities. So you would expect a development premium. Now this is all cropland and woods today. It doesn't have any utilities, no sewer or water to the site. It is not zoned anything but agriculture. And it brought $29,000 an acre. So somebody's really betting on the come there, I think, in that location. And then we had some private sales. I asked my staff way back in September what they thought the farmland market would do or what it had done. I'm sorry, this is looking back. And you can see here that their thoughts were that everything from best cropland, average cropland to rural residences and woods, everything had appreciated in value in the farmland space in the last year. You might ask, who are the buyers today? And these are our buyers from our actual sales results. And you can see this vacillates over the years. Usually it's a majority farmer buyers, somebody who's going to drive a tractor, plant the seed and harvest the crop. This past year was 50-50 split between farmland investors and farmers. Those farmland investors are not foreign entities for the most part, very few of those. These farmland investors would be individuals that live in Indianapolis or Lafayette or Fort Wayne, and they want to own farmland as part of their portfolio. Generally speaking, it's not the institutional names that you hear. Certainly, there are institutional clients buying farmland out here, but it's a small percentage of the overall transaction value. number of sales compared to previous years. And had you looked at this slide a year ago, it would have said, oh, 90% same. Our staff would have said, yeah, the same number of sales, very few would have been the answer. But in this pie chart, you see that 36% of our staff said, yeah, there's more on the marketplace. And that's consistent with that higher transactional volume Todd showed you on the slide a little bit ago. And then I asked them, just in your opinion, who's the dominant purchaser in your marketplace, irrespective of pulpwood sales, but all sales included. And you can still see they felt like 75% of the time the farmer is the dominant buyer. And that is a consistent number across the Corn Belt. I know Todd referenced the Iowa State survey, and they asked the same question. It tends to be 80-20. So before you think that the farmer's not that dominant buyer, they certainly are. The Purdue Ag Barometer, this is something that I think tends to influence farmland values to some degree. It had anyway, up until the last 4, 5, 6 months. And I think this jumped up, this report came out this morning from Dr. Mintert, and Jim said it jumped up from 116 to 125 for the month of December. Again, as a reminder, for those of you who haven't heard, this is 400 farmland producers across the United States, not Indiana, but across the US, and just their opinion on how they feel like the ag economy is doing. And it's an improvement over the November survey, a low of 116. And you might say, well, gosh, Howard, here you have all these high sales in spite of the fact that the overall ag outlook was dwindling. Well, I guess keep in mind, this survey is from 100 or 0 to 200 point scale. So even 116 is above average. This is the one time period, the last 6 months, that has really not been consistent with what we've experienced in the farmland market. That previous big decline, well, that was when COVID happened in early 2020. And you see that big valley there. Well, what happened in the farmland market? It shut down. So it is somewhat reflective of what happens in farmland. For the last few months, it hasn't been necessarily. I think that's more fears driven, obviously, than reality. Will inflation be a factor? And farmland is very positively correlated to inflation. And so there was this study done by USDA and Moody's Analytics, and they basically hypothesized what US farmland values, and Todd showed you that chart earlier, what they would do over time, but depending on various rates of inflation. And obviously we've been probably in more of the elevated inflation over the last year. If we go to more moderate or low inflation, you can see what they're projecting those US cropland values to do. So farmland debt, that's always a part of the discussion. I think Todd had the debt to asset ratio or debt to equity ratio. I just look at the overall debt, inflation adjusted. We are very similar to the levels we were in 1980. Now, if it wasn't inflation adjusted, it would be much higher. But we are very comparable. Real estate debt is higher as a percentage of overall debt, but we're about the same level. And you might say, well, gosh, Howard, why is that not problematic for farmland? Well, here's why. The average interest rates on non-real estate loans, but it would also apply to real estate loans, compared to 1980, which was the previous peak at 18%, we're down at 4, 5% for farmland. So that is the major reason why debt is not a huge problem for the ag sector today. Best debt service ratio in decades. And obviously this is just reflective of the fact that low interest rates leads to a low annual payment to service $1,000 of debt. And that applies to the federal government's debt as well as our own. So here's total debt versus interest expenses. And you can see this graph really shows it well, where you see the farm sector debt is the blue or the gray line, the orange or brown line is the actual interest expense. And so as long as interest rates remain low, we're in pretty good shape. And I presented at the Brock seminar about a month ago, and I asked a farm credit representative in that meeting, I said, well, what are your current percentages of fixed rate loans versus variable rate loans? And Natasha said it's 75, 80% fixed rate loans. So even if we get interest rates shooting up like they did in the late 70s, it might mute the impact a little bit because we have so many fixed rate mortgages in place out there, which I think is a healthy thing for the ag space. And here's just another way to look at debt divided by income. So the total amount of debt divided by income. The warning here is usually around 5 to 6. and a 5.5 ratio. And you can see that we went above that back in the late 1970s, even before the 1980s hit. And so it's kind of an early warning. And we did that again back in 2016, 2017. But quickly that eroded back towards the 3.9 today. So it suggests, as this slide says, clear skies ahead. Share of farm real estate loans delinquent. Yep, they still exist, believe it or not, but right at the average, long-term average of less than 2.5%. Here was where the concern was. Prior to 2021 was this evaporation of working capital. And you can see the working capital had really built up. The cash on hand had built up in 2010, 2011, 2012, and had really eroded into 2020. I think that has probably will recover substantially on this chart when we get the 21 results. So where do values go from here? I've alluded to these factors: farm incomes, so commodity prices times yields, interest rates, and supply of farms for sale. We had great incomes from 2007 to 2013. Then we had the cash drain, lower commodity prices, lower incomes for that 5-year time period that we kind of hung at a very flat level of a rate of change in terms of farmland values. Government support became absolutely critical in 2019, 2020 with market facilitation payments and CFAP payments. And then interest rates, obviously they stayed low and the farms for sale were below normal as well. So all positive things. Here's the farm income chart. Todd alluded to that with one of his. You can see it's creeping back up here for 21. I think that's why working capital builds. Impact of USDA payments. And you'd say, well, yeah, there are a lot of payments that came out. Here is actually inflation adjusted all-time high numbers, at least since 1970, in terms of overall payments to farmers. Here's a breakdown between the net farm income, the blue part, and the orange, which were direct payments. So you can say, well, yeah, farm incomes were up in 2020, Howard, but it was largely due to those direct payments. Here's another way to look at that. When you take the inflation adjusted net cash income less the government program payments, 2020 actually was a decline. 2021 will be a reversal of that, thankfully. And then we have the impact of fertilizer prices. That's one of the big concerns as we look at next year, and they are extremely high, no doubt about it. It's going to cost a lot to put an acre of corn out, acre of soybeans, and probably looking at break evens well above $4 on corn and well above $10 on soybeans. So as you start to think about the current pricing of corn and soybeans in the marketplace, think about the input costs. Impact of timber values. I mentioned earlier that recreational and timberland was moving up in value, and you can see the average timber value has been moving up across the last few years. We talked about cash rents real quick. I asked our staff back on September 1st, are you going to increase rents at all? Well, did you have any higher results? And you can see that, yes, they were going to increase rents. Yes, they had some higher results. That's not a surprise. A lot of rents for 21 were negotiated in the fall of 20 at lower commodity prices. So seeing an increase for 22 is a surprise to no one. Supply of farmland for rent, just really low. Demand for farmland to rent, very strong. Therefore higher rents. Do you have any tenants in distress? And yes, there are some out there, believe it or not. We've had a couple of receiverships we've done this year. Cash flex leases, we use a lot of these at the Halderman companies on farms we manage. 90% or a very high percentage of them are already on cash flex, which the bonus payments that came in December to some of our landowners were pretty significant because of the really good income situation on the farm this year. So as we think about cash flex leases for next year, base gross revenues, anywhere from $640 to $900 an acre on corn and $410 to $650 on soybeans. Those high-end numbers have really moved up $100, $150 an acre due to the higher input costs. But there was some change in base rents, largely on the plus side, moving up toward $250 an acre for the base cash rent, which is the guarantee to the landowner. So as we finish up here, talk about where we think farm real estate is going to go in 22. Obviously, world demand fundamentals, and if you read the report on Pro Farmer today, there's some concerns about weather in South America, and boom, soybeans and corn move up in price. That's that just-in-time delivery impact. It's impacting all industries, supply chain issues, but there's that world demand that exists out there that's very bullish for agriculture right now. Interest rates still very favorable. Todd showed you that chart from the Federal Reserve Bank. Every quarter that this comes out is they report, well, this is the lowest ever in recorded history. Sometime that'll change when interest rates start to creep back up, but 4.01 for 15-year fixed money is pretty cheap. Supply of farms for sale picked up in the fall, but what does this coming year offer? And then what will be the government support for 22? I doubt much, would be my opinion. And obviously input costs are rising. So is cash increasing? I think it has. Input costs will probably erode some of that, and it really will be a matter of where do we come out on commodity prices. And I would say look at the month of February. And if corn and soybean prices remain fairly elevated in February, keep in mind that's when you set your revenue crop insurance pricing, and that could be having a big impact on farmland as we look at 2022. So cropland values are certainly in an uptrend in our opinion, and that will continue in 22. Probably won't be as brisk of an increase as we saw in 2021, but still strength in that marketplace. Likewise, in all other sectors of the farm marketplace, you're going to continue to see stronger values. Average to below average farmlands, hassle farms, those are still less desirable than the prime productive ones. So where do we go from here? And I'm going to fall on the bullish side. I'm going to show you a bearish slide, just kind of tell you what I would warn you about. But right now we have profitable prices, both for last year and for this year's crops. You've got a low amount of debt, low interest rates, low supply of farms for sale, relatively speaking. And biofuels, the RFS remains somewhat supportive, and world population growth. So all those things are very positive factors and remain in place. So what could be a problem? Well, this pandemic and Omicron variant or some other variant really shuts things down again. That would be a problem. Trade issues. When you hear about Russia versus Ukraine or China versus Taiwan, those could be some things that erupt. That could be a black swan event that could impact prices. US and global production right now is enough. Could that, if South America really gets some better rains, that could lead to lower commodity prices. So there's some things to watch here. Interest rates moving up. I think that probably happens this year. At least the Federal Reserve Bank is indicating 1, 2, maybe 3 rate increases this year. Something to watch as well. I think if those are quarter point increases, maybe we go from 0 on the Fed funds rate up to 1%. I don't see that as being a huge impact. It would take 200 or 300 basis points of increase to really have a big impact. And then Todd talked about other asset classes. So what happens? What does that mean, Howard? Well, if CD rates go to 3% and your cap rate on farmland is, I think Todd said 2.8, then maybe you invest in treasuries, maybe you invest in other fixed income assets versus farmland today. Right now, farmland has an advantage. So that could lead some of those institutional buyers to make a change. Right now, stock market's been better than farmland or very comparable to farmland this past year. So a lot of folks have enjoyed that, but if there's a decline there, farmland remains a much less volatile marketplace than that. Working capital concerns are over for now. So I'm going to leave you with this thought. We are looking at bullish fundamentals, higher prices, demand for rental land, and then I think that equates to higher land values. So probably 5% increasing this year. That would be a much more common appreciation rate for farmland than this rapid jump we saw the last 6 months. But I think that's where we're going here in the near future. And that's what our survey said back in September. Largely 8 of our staff said higher 2 to 15%, same for rural residential lots and recreational land. So with that, I will conclude. I think you know how to get a hold of us. We are right at 1:58. So Nolan, we have time for questions, both for Todd or for me. Todd, you can't hear us? You're muted there.
Nolan needs to turn on his microphone.
Yeah, I think I hear
Nolan
Nolan
needs
on
to
your mic.
Good point. So what Nolan was saying is if you have any questions, please ask, send them into the chat. Todd, did you have anything that you wanted to follow up on from your presentation?
The only thing I didn't include as much credit or debt information as I sometimes do with these kind of things. The other thing that we're seeing a lot of, particularly through the Federal Reserve surveys, is a lot of loan repayments. So farmers have a lot of working capital, as you mentioned. We're seeing a lot of trouble with purchasing machinery, as I imagine most people know. And so people are left with cash and wanting something to do with it. I think part of it has to do with tax expenses and wanting, at least where I grew up in the Ozarks, you're trying to always drive farm profits to zero. One of the ways to do that is to pay off debt early. And so we've seen actually record amounts of prepayment on loans, paying down debt. And also new loans, the demand has been falling quite a bit. So I think farmers are going to be floating a lot more based on the retained earnings in the last couple of years, and not as many places to just go out and spend it.
Yeah, so that gets translated into land value sometimes, right?
Yeah, or you can always talk to the development office of Purdue Ag, I guess, if you've got a lot of money sitting around, you don't know what to do with it.
Nicely done, nicely done.
I
just read the article where Don Vilwalk and his wife, they did a grain gift. So that would be an option as well for anybody looking.
Make sure to tell my dean that I said it. So
I will do that. I will do that. All right, Nolan, have you seen any questions? No, we don't have any questions. So if you will, okay, here we go. Here's one. Do you see any correlation between timber price increase and the general rapid housing increases? I would say yes. I don't know, Todd, if you agree, but certainly a lot of our hardwood timber, and I guess that's one point to make. We are not in the Southeast. The Southeast or the Pacific Northwest, a lot of that is pine timber, softwood that goes into 2x4s and home actual construction. A lot of Indiana's timber, most of it is hardwood timber, which oak, walnut, cherry, maple, those are used in cabinets. Those are used in furniture. And certainly with a lot of the rapid expenditure of money on your homes or home offices, because you're going to work from home, that demand has really spurred on those timber values, I think. I don't know, Todd, if you want to add anything on that.
No, I think that's true. Other than anytime we start thinking about construction or even things like furniture making, the other big part of the economy, the big mystery for all of us economists is what's going on in employment in labor markets. And so we have very low unemployment rates, but we also have a lot of job posting, people are having trouble filling. And that really at the start of COVID really hit trades very hard. And it's more in like sort of seasonal employees, which again, that's where like construction comes in as seasonal employment. So that's the only thing I think it could kind of maybe throw a wrench in there between where we usually see correlation is really the ability to take sort of raw commodities, whether those be agricultural commodities or timber commodities or metals, and turn those into consumer products is getting harder to do.
Yeah, excellent point. Did you have a second question, Nolan?
Yes. I'll just read it to you.
Yeah, turn your mic on.
Sure.
We had another question. It was, how does a farmer justify paying more than $10,000 an acre for farmland when the LT return on land is currently only 2.9% in the view of higher input and machinery costs?
Todd, do you want to address that or do you want me to?
I'll start and then you can see if you disagree, or maybe we'll, I think, again, it always kind of comes back to what's the earning potential and what's the discount rate people are comfortable with. If you look at data for farmland transactions, and my buddy Wendell Zhang at Iowa State does a great survey about land ownership in Iowa, most parcels that are owned tend to be owned by someone for about 30 years. And then half of that they give then to an heir. And so the ownership structure for these are very long. And so when you start thinking about, how does this make sense? Often those investors that seem to be paying, very high amounts for land are often looking at a much longer horizon, I think, than things maybe make sense of the next, you might have a couple bad years, but if you look at the data, if you would have bought farmland in 1978 or 1979 and had it rapidly decline, if you could afford to hold on to it for just 7 or 8 years, you're back into the positive again. So a lot of times those differences, when you get to especially like higher price transactions, it's really what's the investment horizon that they're looking at. And if that horizon is much longer than somebody, I would love to own more farmland, someone that's still 25 years away from retirement. But thinking about it in that long run perspective, and it may not make a lot of sense right now, but I would think 20, 25 years from now, I always kind of suspect that's always my first hunch as to what's going on.
Yeah, and I would agree 100%. That what we see, first of all, if it's a farmer buyer, which 75–80% of your buyers are farmer buyers. If it's a farmer buyer, they'd use the portfolio approach. And they've got some land that they probably farm that grandpa bought at $500 an acre. And so they're paying maybe $10,000 or $11,000 an acre now. If you average that across the whole portfolio of everything they're farming, it's really a cost structure, cost per acre, and it works out. So that's one way they think about it. The institutional investor or the financial investor that's an individual will look at it and say, well, what can I get on some other types of assets? And when you compare farmland returns to fixed income returns, that I think on your chart, Todd, you showed consistently is 7 to 9% total return for farmland over the long term. That tends to be pretty appealing and competes very well in that space. And I know the institutional clients that I talk to that we have investing through Halderman, they tend to say, yeah, this is just a long-term play for us. This isn't invest today and sell in 5 years. This is a 20–25 year horizon. And so to your point, I think that most people, when they invest in farmland, it's not hot money. They're not day trading farmland. They're really looking at it and saying, I'm going to invest it and I'm going to own it for forever in theory. And as a result, historical appreciation in farmland is very competitive with most other financial alternatives.
Yeah, I think when you look at the institutional space, I think there's a lot of people in the ag community that can tend to think of them as like sort of Gordon Gekko or like 80s Wall Street type folks, but they're predominantly pension funds or life insurance, people that have very long holding and investment horizons. So they're looking at, what's going to happen over 30 years when I take this money in from a young person that's got a retirement account, and then they're going to come back to me in 30 years for some amount of payment on that annuity, then what's that horizon look like? They're not looking at sort of like, it's not like a real estate TV show where they're going to try to flip it as fast as they can.
Exactly.
Yeah.
Other questions, Nolan?
I don't have any more right now.
Okay.
Oh, here's one.
So the question is, what are you predicting on the estate tax and capital gains that have been proposed? Would that not force a lot of sales to pay off the tax and ruin a lot of young farmers? John, you are exactly right. If the step up in basis were to be implemented and it actually did not exempt farmland, which keep in mind, I think they had always proposed that farmland would be exempt from that, it would be a huge capital gains tax that would be owed immediately, in theory, if that had passed. And that would, you would have to sell some land in many instances to pay that tax. That would be particularly heinous in my mind. I think the reality is that if we see higher taxes on the horizon, it's probably a percentage increase. So instead of the long-term capital gains rate go at 20% currently, maybe it jumps to 25%, maybe 30%. I think in one proposal, it was to take it to your income tax bracket rate. That I think is much more likely than a tax, immediate step up on basis and taxing it annually. I think that hits a lot of people in a lot of different sectors. And I just don't see that going anywhere from what I've heard. I don't know, Todd, if you have other opinions on that.
No, I think that seems about right. One thing to always kind of keep in mind that gets lost and you get into the weeds, and I don't want to bore everybody with taxes if you don't care too much about taxes, but there's often provisions that if you're underneath some sort of asset or wealth cap that you're protected from the higher tax rates. Most farmland owners tend to fall under that. The other group that tends to get protection is small businesses, and so farmland and farming falls into that as well. But the government, I don't think, doesn't want to break up businesses by enforcing these taxes. And so generally, where I think it would be potentially trouble for farmers is if you're renting from a tenant or for a landowner that has very low connection to agriculture and owns a huge amount of land. If those inheritance will be affected, but generally it's a really small. The USDA did a really great study about estate taxes, and it's a very small percentage of agricultural producers that actually will be impacted. And
yeah, that
And not a
estate
lot of,
tax.
and not a lot of those are here in Indiana. Oh, yeah, sorry, the capital gains tax. Yeah, I think there'll be enough provisions that I don't think it'll be as an economist, I'm generally skeptic of anything that seems like a big doomsday. I think in the future, we'll be driving cars that are like better versions of the cars we have now. We're not going to wear foil suits. It's not going to be that much different than now. So I think they try to keep that protection in the provisions.
And my thoughts on estate tax, I think you could see a lessening of the estate tax exemption, 11 million per person now, maybe it drops to 5 million per person. And that would require some folks to do some estate planning. You would have some farm operations that might get hit with being over that amount now. But I know, talking to the one estate tax planning attorney that we work with on the ag side, she said she was just absolutely slammed this past year with people wanting to plan and be prepared for that. So there are tools out there to allow you to put things in place to make sure that you can pass things on to the next generation. And if you have questions about that, we will have to help people out and navigate.
Yeah, I think the high fees with either capital gains or estate taxes, the higher fee than taxes might be attorneys and accountants, but that's my economist skeptical take, I guess.
Bill, you asked the question on how do you find a description of the Wapi index. That is something that we could do online today. I think we use a product called Surety, but we will send you information on that. So Nolan, make a note of that so we can send Bill how he can find that online. All right, well, we are about 11 past the hour. I don't see any other questions at this point. We did record this event, so if you'd like a copy of the recording, be glad to share it with you. And I just thank everybody for joining us this afternoon. And as you think about your farmland for this coming year, I'd say if you're an owner, it's good news. If you're trying to buy, yeah, that might be a little more of a struggle, or you're going to be looking at price points that you have not expected. But agriculture remains a good, safe place to be, as it has for decade after decade. So with that, we will let you get back to the rest of your day, and thank you for joining us.